Hello viewers, welcome again to Already Late, and this is Dr. Alok Chajed with a new topic today. In my last video on debt investing, I explained about debentures and the credit risk associated with the debenture. If you have not watched it, I strongly suggest you first watch that by clicking on the link visible on your screen now and come back to this for better understanding. The second risk associated with debentures is known as interest rate risk. Now, what is this interest rate risk? To understand interest rate risk, I will continue with the same example of Reliance Industries issuing a debenture for 10 years with an interest rate of 9%. The person who holds this debenture will continue receiving interest at 9% every year. You already know that. Further, you also know that the market price of this debenture will fluctuate as per the demand and supply in the market. One of the factors that affects this market price of the debenture is the interest rate prevailing in the wider market. The most commonly followed interest rate is repo rate, which is the rate at which RBI lends to other banks. The interest rates on fixed deposit and loans tend to closely follow the repo rate. Now the question is, how will this repo rate affect the market price of the debenture that we are speaking about? To answer this, let us take a comparison between the interest rate earned on this debenture with the interest earned on fixed deposit. Let us say, for the sake of our understanding, the rate of interest on a fixed deposit is 6%. This means that the debenture issued by Reliance is earning 3% more than the bank fixed deposit. Now, let us say, for an example, RBI increases the repo rate by 50 basis point, which is just equal to 0.5%. So now, as a result of this, a bank deposit which was earning 6% will earn more than 6%, let us say 6.4%. Now, please note that banks generally do not pass this entire benefit to the customers. Otherwise, your interest rate on fixed deposit would have been 6.5%. So now, Reliance is still paying 9%, FD is now earning 6.4%. That means the difference between the two, which was earlier 3%, is now less. It is less and it is now 2.6%. This makes this debenture little less attractive. So now in the market, if there is a buyer who wants to buy this debenture, he would not want to pay the value which was prevailing before the interest rate, because now the bond is less attractive. The Reliance debenture is less attractive. This is not all. All companies, including Reliance, which will issue debentures henceforth, will have to pay slightly higher interest on their new debentures to maintain the attractiveness for the investor. This means while the earlier issued debenture which we were talking about was giving and still gives 9%, the fresh debenture issued by Reliance will be issued at around 9.4%, which is 9.4%, if the company wants to maintain the 3% extra return over the bank fixed deposit. This will also make the existing debenture, the 9% debenture which we have, a less attractive, because every investor would want to invest in a debenture which is now giving a higher interest rate. So if anybody in the market wants to sell the 9% debenture, he will have to sell at a lower market price. So now you can safely say that interest rate risk is a fluctuation of market price of a debenture due to the change in interest rates in the market. Now, continuing our journey with interest rate risk, let me pose another question to you. If there are two debentures of Reliance, one maturing in 5 years and the other in 10 years, and let's say both of them are earning the same 9% interest per annum. If I were to ask you what will happen when the deposit rates increase, you will jump around and say that the prices of these debentures will definitely fall. But my question now is, will both these debentures fall more, or one will fall more, or one will fall less, or both will fall same? The answer to this is also very simple and very logical. The debenture with a 10-year maturity will fall more than the debenture with a 5-year maturity. Why? Because the 10-year maturity debenture is earning relatively lesser for 10 years, while the 5-year maturity debenture will earn less for only 5 years. The debenture with longer maturity remains unattractive for a longer period of time, and hence its price will fall more. Now we have learned two things about interest rate risk. One, when interest rates go up, debenture prices will fall, and the longer maturity debenture will fall more. Now in this video, I have spoken about a situation when interest rates increase. What will happen when interest rates go down? Want to know? Simple, the prices of the debentures will go up. Now as an investor in debentures, how can you use this learning? If you are expecting an increase in interest rates, you are better off being away from debentures or be invested in debentures with shorter maturities. On the other hand, if you expect RBI to reduce rates, you should be investing in debentures with longer maturity because they would move up more. One thing to remember is interest rate risk affects only the market price of the debentures. If you are an investor wanting to hold the debenture till maturity, you will continue to get your 9% every year and your investment amount at the end of the tenure. There is no impact of change of interest rates in this situation. Hence, interest rate risk affect your investments typically in debt mutual funds, as the fund manager regularly buys and sells debentures in the market at prevailing market prices. Do like this video to encourage me to continue making them. Do comment with your feedback. Do subscribe to my channel and recommend to others. And finally, do not forget to press the bell icon after you subscribe. Thank you. Happy learning.